You have to adjust your investment strategy for today, not the past. We all know what we should have done in the past.
Sure.
But what you really need to know is what you should be doing today, and recognize what an opportunity is today, not what it was 3 years ago.
Welcome to the Investor Empowerment Series radio show, empowering your real estate investing with techniques, opportunities, and information, minus the BS and sales pitches. Now, please welcome the host of the Investor Empowerment Series, Joe Mueller, from the Tough as Nails Investment Syndicate. Joe Mueller.
Doug, great to have you on the show today. Could we start off by hearing a little bit more about who you are and how you got started and what your involvement in the business of real estate is?
Well, the first thing I probably should say is that I did have the good fortune of joining TANIS Group Realty about 5 years ago. There's a little story. Well, no, there's a little story behind that, which I can get into in a minute. But I have been a realtor for the past 35 years. Entered the profession by accident because I was a vice president at a major bank in Chicago, the first too big to fail bank that failed. And when we, were acquired by a much larger financial institution, I lost my job because consolidation, thousands and thousands and thousands and thousands of people were let go. But the reason that I had my real estate license when that executive career went down the tubes is because I had a home and was trying to sell it myself. I had a realtor that just put little notes in my mailbox, suggesting how he could help me. And we actually became friends. And he was kind of very entrepreneurial like you, like to, take control of matters in his own life instead of letting people direct his life for him. And he opened his own brokerage. When he opened the own brokerage, he jumped on the strategy that many brokerages use even today, even the large, national brokerage companies. They try and get people to get their real estate license and become realtors, simply because the more people that have their licenses and post them on the wall, it raises your chances that, maybe a few of them will sell some properties and your brokerage business would go up by that. So he got accredited to teach the real estate class and, go off from there trying to, recruit agents that way. But his first class, he called me up and said that, Doug, I need you to do me a favor. And this is like we were friends. He said, can you just take my real estate class? Because if I don't have a pass rate of over 50%, I will lose my accreditation for the school. So, he was under the wrong impression that I was smart. But so I agreed to do it. And, of course, I passed the test. So I had this real estate license. But I personally don't like the sales business. I don't like or think it's right for people to try and to talk somebody into buying something that they may not need or want.
Sure.
And that's really, a lot of sales is about.
Right.
So I got the real estate license, and I thought, well, I will never use this thing because, I don't want to talk people into doing things that, may or may not be the right thing for them. I personally, to this day, I don't want to go into a store where the minute I walk in, can I help you? And you respond, no, I'm just looking. And they respond, well, what are you looking for? And if you accidentally put your hand on a sweater or something, they're, telling you how great it would look on you and push.
Sure. So
I really did not even have a high regard for the real estate business. But after losing a really good job and sitting around all day, and the job market wasn't that great at the time, and a little thought in the back of my head, really, I maybe I don't miss corporate America as much as I want to. I thought, okay, I'm going to take a chance at real estate, but I'm never going to be one of these people that, tells people what they should be doing. I'm going to listen to see what it is that they want and help them find it no matter how long it takes. So and then 35 years later, yes, I'm, in the real estate game. I was with Century 21 for almost 20 years, and it was just a small office where property management became the focus, and there wasn't a lot of investment in the brokerage. And I'm still friends with that broker today. Tried a number of the national firms and didn't find that to be the right place for me. They do a great job, but they're very regimented and don't really do things. They don't do things uniquely. It seems like they all kind of, copy the same business model over and over and over again. So with you, 5 years ago or 6 years ago, when we were all coming out of real estate collapse.
It seems like decades.
Yes, but I'm out showing houses, and every time I'm looking for houses to show people, I keep seeing TANIS. And who I thought, who are these people? And, I kept, I was selling a lot of your properties. Well, one day the light bulb came on. I wish I had flipped that switch a little bit earlier. And, why is it that TANIS has these great deals? And, why are there so many of them? Well, you had worked out all of these arrangements with banks and government agencies like Fannie Mae, Freddie Mac, HUD, to market their properties, from the massive amount of foreclosures that were coming in. So, I thought, this guy is doing something right. He is getting large inventories of really good properties to sell, and it's because of your relationships with these banks. They were basically, at the time, probably, I don't know if it's a good word to use, but they were dumping a lot of their inventory, and you were one of the bigger companies to service them. And one day you ought to get into that. It's not easy to service these foreclosed properties and the asset managers that you have to deal with. But so I thought, what, I think I'm going to go, explore this TANIS Group thing a little bit more. And the first time I made contact with the company, I thought this is the place for me to be. And it is the best decision of my life. And boy, this is starting to sound a little bit like propaganda, or that I was planted to say all this stuff.
Yeah, it does. That's okay. So let's. So the best decision of your life. I appreciate that. I don't want to cut you off, but I have a question. I have two questions, and I think that would be the answers could be potentially beneficial to the listeners. First question is, and I don't need an exact number, but one could probably guess after 35 years in real estate. You've seen the cycles of a real estate market.
Yes, I have seen the cycles, but what I have seen more than anything else is that people that have invested in real estate, pretty much no matter when they did it, are better off today if they're still holding that real estate. Now, of course, there's always a few exceptions out there, but people that bought an extra house or a little apartment building or anything like that and were just disciplined enough to pay it off are sitting there on an asset that is just churning money.
Right.
So real estate is a hard asset, and that's one of the reasons I was glad you invited me to, talk a little bit today. Is an asset that is always going to have value. It is a hard asset.
Explain to listeners, for those who may not know, what a hard asset is.
A hard asset is something that isn't just on paper. For example, a stock is not really considered a hard asset. It's just something that's on a piece of paper that could really disappear with an electronic transaction. Hard assets, and we can get into, different aspects of, his good and bad side. I know, Robert Kiyosaki comes up. He has always advised investing in hard assets. Hard assets would be real estate. Another one that he likes to talk about is gold. You can actually hold gold in your hand as opposed to a paper asset where you bought gold like in an exchange-traded fund. And everybody has, this question behind their, does the exchange traded fund really have this warehouse of gold somewhere that they say I own. So a hard asset is something that you can feel, hold, and touch.
Great.
And it won't disappear, if there's some, calamity in the financial system.
Right.
People always need housing. Last I checked, the population of this planet exceeded 7 billion of us creatures. So the demand for housing is always growing. And if you have a little building with a roof on it, you should always be able to make money off of that.
Right. Okay. And I think one thing to point out to those that are interested in investing in real estate and comparing, a hard asset to, a soft asset, which would be something on paper, is something that I've learned through talking to other investors that are seeking, lenders or private lenders to help support their acquisition and the rehab of properties, whether it be for fix and flip or for building their portfolios, is that when somebody gets in, and even in a private lending situation, they're also benefited by the fact that they are lending on a hard asset. So something that you can physically see, touch, and feel. If that investment goes awry and doesn't work out, hypothetically, well, not hypothetically, that lender is going to end up with that hard asset in their possession, hopefully at a discounted price based on the fact that they did a little bit of due diligence and realized that whatever investor they were lending to bought that property, by purchasing it right up front. So great point to bring up is the differences between, that hard and soft asset class, because a lot of people put their faith in the stock market. They've got IRAs and they've got 401ks and they're pumping all this money into mutual funds, and what they forget to realize, or maybe they do, but they just don't focus any further or think outside the box because that's kind of the norm, is that they're really under the control of a stockbroker or someone else making a decision on what happens with their money, and they've really got no skin in the game themselves. So if things go south, whoops, sorry, you lost 10% on your investment portfolio.
It's gone. I mean, let's say you own paper in Radio Shack, and then, one day you wake up and you read the newspaper and you see, Radio Shack is bankrupt and out of business. Well, your piece of paper is not worth anything. If you actually owned the building where there was a Radio Shack, yes, you can still go feel and touch and see your investment.
Right, exactly. Okay. We touched on that real estate market, that real estate cycle question. Is there anything else you can add about the ups and downs you've seen, and maybe compare it to what you're seeing right now in today's real estate market, comparatively to like 20 years ago, for example?
Yes, and this gets back to, really appreciating one of the things that you're doing is that there's a lot of people out there selling classes and seminars and courses and things on how to buy real estate. So people have a lot of paper from these classes, and they don't have any real estate. And the thing about these classes, most of them, and they're pretty sophisticated business models, it's a constant process of upselling. You can take their initial class for $3,000, but, you take that class and it's only to upsell you into their $15,000 class where you learn more secret and tricks and things, ways of acquiring real estate that nobody else knows, other than the 200,000 other students that have paid the same amount of money. And these secrets are not really secrets, and they're mostly taught by people who have not been successful in the real estate business. Maybe it's, I don't know if this is appropriate, but this is a good point to bring up, like Robert Kiyosaki again. His history is a very smart man. I mean, you got to give the guy credit for,
Sure.
being, smart. He wrote the book Rich Dad, Poor Dad.
Mm-hmm.
There is no rich dad or poor dad. This is something he concocted out of space, yet he, makes it seem like it's his life story. And from his life story, he sells seminars. A lot of the people that investigate these, real estate experts find most of them own little or no real estate. And Robert Kiyosaki is one of those people.
Right. Well, I know he has, and he's gotten involved.
And so, again, this is just, buying a bunch of paper. Now, I think that, one of the things that TANIS does, it makes it a real estate business unlike almost any other, is that you take the time to educate people on how they can obtain hard assets. You also take it to the next level and tell them the various ways that they can obtain these hard assets, all depending upon their comfort level with risk and their available time and their available skills. And something I'd like to get into in a little while is a personality assessment. Some people are stronger at dealing with people than others. If you don't have a strong personality, or you can make a good argument or, kind of crack down on a tenant, instead of being afraid to talk to them, you have to factor in what are your skills. But you offer all of this, really good education and tell people, in a very quick way how you can acquire properties through courts or through auction sites or through tax sales or through non-performing notes or all these other things. But the one thing that, to me, is getting diminished in all of these conversations and all these alternative ways of acquiring property is that the multiple listing service seems to get overlooked. And from what I hear in all of the experts that you've interviewed, and when I call these people experts, these are people that are very successful in their real estate investing careers, is they all admit to using the multiple listing service as a source, one of their sources of acquiring properties, but it seems like they minimize that and like to talk about their something that they perceive as a bigger acquisition, like getting something at a court auction.
Right.
But for the average person that does not want to just commit their entire life to real estate investing, with the objective of getting rich in real estate investing, I think that purchases made through the MLS have lower levels of risk than what you might obtain if you bought like a non-performing note. And just for people that don't know what that is, it's simply that financial institutions that are holding a mortgage paper are oftentimes willing to sell one that is not performing, where the property owner is not paying their mortgage or something like that, and to avoid the hassle of foreclosing or just the process of collecting or trying to bring them up to date, they might say, let's get this off our books, and it might be like $100,000 mortgage, and we'll put it out to a broker, and if he could get us $50,000 for this, we'll get that off our books.
And I think you just brought up a great point about the investor and the level of risk, especially for somebody who's just getting started. So if I could interject real quick, one thing that it still somewhat amazes me, and it's in alignment with what you just said, which is, we'll have investors that come to work with some of our people here at TANIS to try to build, their fix and flip business or a portfolio, and, they're given the MLS as, of course, one of the options, which I think is what everybody on the show says. It's always one of those streams of, that pipeline of potential deals, because they do exist. And even though you're able to, 9 times out of 10, you're able to access the home, you're given disclosures, you have essentially somewhat of a free reign opportunity to have inspections done and have your contractors run through there, get your bids, really do your due diligence and homework. They get like hair on fire when they hear the word wholesale deal, and half the time they have no baseline of where this property is coming from, what the actual interior could look like. They're not given the opportunity to always do inspections. I mean, it's definitely a higher grade of risk, yet a lot of these investors, and I'm kind of maybe grouping the newer ones into this category, is they run to the property right away and they think, oh my God, this is the greatest opportunity. I got to get on top of this right now. And at the same time, they're turning away the opportunities that are right in front of their face that are less risky and basically easier slam dunks, especially on a newer level. Why don't we just talk about that a little bit more specifically, maybe with an example or two on what you're seeing in the MLS or what opportunities you've been able to provide investors with just through MLS acquisition? Because I know we haven't really talked about it on the show, and I think it'd be beneficial for the listeners to hear that there are opportunities out there. And I often say that, I bet I mention it at least every other podcast about how the MLS is always a source. So please, through your 35 years of experience, let's give some more current examples of what's going on and maybe some of the opportunities you've provided for investors in the recent past.
Right, and I just want to point out again that that it is a source, and most of the real estate, the successful investors that you've interviewed, admit to acquiring properties through the MLS.
Right.
But it just seems like not doing it that way is it seems like somehow a better achievement or something like that. But anyway, again, I want to go back to the point that the MLS offers the largest pool of properties available. Mm-hmm. There's many more houses, and properties in the MLS than there are like at the Kane County Courthouse on auction day.
Sure.
And the thing about it, the MLS, is that banks, the financial institutions, properties, the government agencies, HUD, Fannie Mae, Freddie Mac, they all put their properties in the multiple listings. Right. So if you are looking for a foreclosed property, and I continually emphasize to investors that the word foreclosure is not a synonym for a good deal.
Right.
Many foreclosures are good deals, but not all of them. And when we get these calls in the office, people, wake up one morning and think, I want to, go into real estate investing. Hello, I'd like to buy a foreclosure. Well, it doesn't mean you're calling me, to get a good deal.
Absolutely.
So, multiple listing service offers homes from everywhere, just normal traditional sales, short sales, where people are underwater at their house and they're asking their bank to let them sell the house for what it's worth and not what they owe the bank. Those sometimes are opportunities. Even the auction companies. Now, this is different from a court auction. We're just going there to buy, the note on the property. Auction.com and places like this place their properties in the multiple listing service.
Right.
So, if you are an investor, you should not overlook the MLS, and I don't think it should be the third, fourth, or fifth choice. I think it's a place that you should go to first. I have been finding deals in the MLS for years. Now, there's not a flag in the MLS where, just the extremely good deals pop up on a screen. You have to look for them. But once you find them, then it can be purchased through safer channels, like you brought up, home inspections, disclosures, and things like that. The opportunity to visit the property multiple times, as many times as you want, with your contractor, your partner. When you get home, you forgot to look at something, you can go back and look at the property.
And I want to jump in real quick because I think I mentioned in one of my first episodes about when you want to make this a business in real estate investing, you have to build a team. And having a real estate broker that is as diligent as you are, as you're mentioning, sifting through hundreds of properties to actually find these deals is somebody that you need to, work with as part of your team. Because I think what happens is a lot of investors, they call up, their cousin or their, Uncle John or whoever, and they have a license, so they say, "Hey, find me a deal." Can't tell you how many times I hear that at a meeting. Find me a deal. But 9 times out of 10, these brokers really aren't trained on even the market that they're working in sometimes, because you brought up a good point in the beginning of the podcast, which is these national franchises. And let's be realistic. I mean, there's no training that's going on at, XYZ banker, for example, that is saying, here's how you find a great deal for your investor. It really comes down to the experience level of the broker and their level of market knowledge throughout whatever area they're working. Now, second to that, comparative to wholesales, as a devil's advocate type deal, TANIS is going through a transaction right now with a wholesale deal that we acquired off market that we're selling to one of our investors. One of the back pocket investors, as I call it. Very experienced, does a lot of flips, also has a rental portfolio, full-time investor. And, based on what you said before, the challenges we faced to get this deal to the closing table are the owner of the property lives nearby. He refuses any type of access. So just getting in to get a village inspection done, which is a requirement to close the property, to get the transfer stamp. It literally took a week to get this guy to be willing to cooperate. He was refusing initially. The investor wanted to get his contractor in there at one point just to get a better idea of what the actual rehab cost was going to be. And I kid you not, it took 2 weeks to be able to coordinate with the owner of the property, have the key, get inside, and the window was like very short. As a matter of fact, the owner ended up showing up while we were all there walking through the property with this investor and his contractor, and basically kicked us all out. So again, for the listeners out there, there's going to be pros and cons to any type of acquisition strategy, but typically when you're dealing with an MLS opportunity, you'll be able to have more of a safety net to complete some of the things that need to get done, especially if this is your first or second or even your fifth flip. Because let's be realistic. I mean, this stuff can, one problem can arise that you could have caught up front in a wholesale deal that, may not have been a problem if you were able to access that property or able to do things through we'll call it the more conventional methods that the MLS offers.
Yes. And you're the best example in the world of how you can be super successful at real estate. But the thing about you is that you have a passion for real estate, and you wanted to devote your life and actually live off of real estate and real estate investing. There's another category of people out there, and those are the ones that I really like to work with, are people that want real estate investments. They don't want to give up their good career or anything else to, use real estate as the magic way to, achieving wealth. They like the security of having a good job, and from that good job, they want to save some money so that eventually they don't have to work at all. Mm-hmm. So for these type of people that just want to have a couple of rental properties mixed in with their investment portfolio of, stocks or whatever else, and CDs and things like that, they want to have, a few in real estate investments so their investment portfolio is diversified.
Right.
And they do not want to go chasing around, going to courts and buying a house that actually they've never seen.
Right.
Or sending out postcards hoping to find a person that might be in some distress or have a reason that they need to quickly dispose of a property, and, count on acquiring an investment that way. They like to say, you know what, I've got some money, and the wonderful thing about real estate is the ease of leveraging.
Right.
Is that I've got some money in the bank, and I'm thinking about using $25,000 of it to maybe, try getting a asset that, could, grow in value over time.
And let's not forget about that. It's not just necessarily the guys out there that are looking to be active in, real estate investing on a day-to-day level, there are opportunities. You brought up diversifying an investment portfolio, which could include stocks and, bonds, mutual funds, gold, for example. We're in the middle of multiple transactions utilizing, and I know we touched on it earlier, and I'm just gonna ring this bell again because I think it's important. Investors are always looking for opportunities to have money to acquire these assets. And one great way to learn that process is to act as a private lender on the backside of that acquisition and that rehab, because you can be a part of let's say a fix and flip opportunity every step of the way. And instead of getting, less than 1% in your annual CD from, the bank of the country, you might be able to well, first of all, you're in full control of your money, and you can kind of decide what you want your return to be. So if an investor comes to you and says, yeah, I've got this great opportunity, I need $100,000 to, fix and flip this property, that private lender can say, well, I'm looking for, a 10, an 11, or a 12% return. You can kind of structure that situation. And I actually just had a phone call this morning with one of our investors who's an active fix and flipper, and he's actually considering doing some private lending, and he's actually got his first private lending opportunity came up as a result of going to a wedding and met somebody sitting at the table who also happened to be an investor, and next thing you know, he's now structuring a private loan that's secured by a note and a mortgage on a property that happens to also be a TANIS sale, which I thought was kind of ironic. I didn't realize that the investor was buying one of our properties that we're listing. So keep that in mind for all the listeners out there, that one way to learn without necessarily paying someone else the education of, $15,000 for a Rich Dad Poor Dad program is, you can get involved on a passive level by using that money you have and lending it out to other experienced investors, and you're lending on a hard asset, and hopefully you've got the time or you've got the contacts to kind of complete your due diligence of that investor in order to be able to feel comfortable with your investment of, let's say, $100,000 that you're going to get, we'll call it a 12% return on over the course of 6 to 12 months, which is, we'll call it $6,000 to $12,000 for basically just lending the money and being a part of that transaction. I mean, what a great way to learn how to fix and flip, or how the process works, by just being that component of, a necessary component of the transaction. So I just wanted to throw that in there. And before we get too far out of the original question, tell me about some of the deals you've been able to...
Just wanted to get back to that, and I'll just give you, some recent examples. And, and I do take pride in these, and of course, it leads to, more business. But we actually had a guy that came to one of our group meetings. It was less than a year ago. And he didn't come as a dreamer. He came, like I'm telling you, he and his wife both have exceptionally good jobs and love their careers. But, with that, they have money, and they want to put the money to work for them. They lived, out in western suburbs, pretty affluent towns. And they also, wanted to buy real estate, but they wanted to be close by so that they could manage it. And I said to him, well, just let me see, if something pops up, you never know. I went on the MLS, and I looked for the lowest price property in the towns that he, liked. And up pops this short sale. And I looked and I thought, I didn't even know there was any type of property at this low a price, as an entry point into this town. I called him up. I said, let's just go check this out. And got to this townhouse, and it needed, I hate to use this word because it's getting so old, but, cosmetic work. I mean, structurally, everything was good. It wasn't, distressed in any way, but everything was worn and nothing was salvageable. But so we put an offer on this townhouse for, I think it was just under 130, 127, 128. And everything else in the neighborhood is selling for 165, 180, and he bought it. And immediately, got in there, and 30 days later had it turned around and had a list of because this is more of a, a white collar, executive type of area, had a tenant in there for $1,750 a month.
Wow.
Now, for him, and then another one came on the market in the subdivision, kind of a distressed situation, but not underwater. I mean, people just needed to sell it. And he grabbed up that one for like, I don't know, it was just under 150. But already, and when the appraiser came out, it appraised for 180.
Wow, that's great.
And here we're talking about a person though that didn't want to go through, a process where you have to continually devote a lot of time to trying to secretly, obtain the property, or through like sending letters to people that are behind in their mortgage payments, or going to a court again where he could never see what the property was all about, or buying a non-performing note. These are all great things to do, and I know that if you have been very successful at these, but with the non-performing note, you might get the house, and you are responsible for the eviction and everything else like that. You haven't really seen the house. It could be a lot worse than you were expecting. So all he's trying to do is get hard assets into his investment portfolio. And he's a finance guy. He's a millennial, and wants to diversify. He doesn't want to just have a bunch of CDs and everything he owns invested in the stock market.
Sure. So
since then, we've made offers on other properties and didn't get them that were perceived as good opportunities. But we're talking about like, a millennial guy. Mm-hmm. I just closed one last week in an area that I like to take investors for a lot of reasons in Hoffman Estates. And there, and it was a short sale. I just don't want people to think, just let's look for short sales, but coincidentally, this was another short sale mm-hmm. that we got for $112,000 for a unit, and this subdivision has probably literally 150 other identical units to this.
Right. And
they're all selling depending on, level of condition and updating. But none of them are selling for less than $130,000. Now, so, he closed that last week. Mm-hmm. And he can already sell it and come out positive. I'm not saying, positive by a lot, but definitely his hard asset has got equity in it.
Absolutely. You brought up the short sale comment about we don't want everyone just running after short sales, but that's something we don't really touch on too often on the podcast, mm-hmm. and I kind of want to jump in and give I'm going to talk about what benefits and I guess the negatives of what comes with a short sale real quick. Just from my perception, I've bought short sales in the past, and I'd say my favorite thing about a short sale is, which most people don't like, is the time factor of dealing with negotiating mm-hmm. with the bank and getting that purchase price approved. In my opinion, if I find an opportunity as a short sale and I write an offer that I'm comfortable with that's going to make me money in some capacity in the future, and it's going to take 6 months for the bank to decide whether or not my offer is good or not, and I basically have nothing at risk, mm-hmm. And it gives me 6 months to continue working on my business and moving on to other things. To me, that makes me feel it's like putting a little visit from the real estate tooth fairy under my pillow. Like, hey, at some point I'll be able to pull that out from under the pillow because the bank's going to call back in a couple months and say, guess what? We've approved your price of $57,000 or whatever that number is, and now you say, okay, great. And depending on what you've got going on at that point, you can move forward with the deal. You could potentially back out of the deal. Again, nothing at risk. And it's something where a smart investor can build up a couple offers that are accepted on short sales. Not all of them are going to work out. The bank's not going to take those low balls every time. Sometimes they do. A lot of times they don't. A lot of times they come mm-hmm. back and counter you. Again, that's another way for an investor to back out of a deal. If they counter back at a higher price of, let's say, my previous example was $57,000. If they come back at $67,000 and there's just not enough meat on the bone to make any money on that opportunity, well, they countered back. So you're back to the drawing board. You can walk away from the deal. You get your earnest money back. So the only con to that is what I just mentioned, which is the earnest money. So if you've got $1,000, down as earnest money, that's going to sit in the escrow account of that real estate broker, whoever's listing the property potentially, for months and months without you having access to it. But in my opinion, I'd love to have 3 or 4 short sales under contract at any given time where I'm just kind of waiting for those opportunities to pop, because every time I have a new acquisition lined up, I get all excited like, oh, I got this new property, I bought it this way. It's like as soon as that acquisition goes through, I'm already out looking for the next one before I've even fixed up the first one. So why not have these short sales in your back pocket as an option? So again, we don't want anyone to just run out and seek out short sales exclusively, but it's a necessary component of continuing to build your pipeline of investing opportunities, and a very safe one at that, because you're not returning back to a courthouse with 100% of the balance within 24 hours cash. You are given months to line up your loan, or maybe your private lender, or your hard money. However you're gonna finance that acquisition, you've got plenty of time to do that. You can vet out the best opportunities. You can get into the property most of the time, depending if it's occupied or not. Obviously, you're gonna have to coordinate with an owner if they still live there. But if they don't, you've got plenty of time to set up everything you need to get that investment acquired and set up your rehab strategy or whatever the situation is with that property. You mentioned that short sale purchase for around $127,000, and you said that the investor ended up renting it for $1,750 a month. Do you have any idea what the net cash flow he's getting off that one property is and the second property is after he's got them tenanted now?
I guess I'd have to put a pen to that, because he is, a traditional type of buyer. So he did a 25% down payment.
Okay.
But again, it was financed with mortgage money.
Right.
Under 4% interest.
Wow. So his payment, even with 25% down, his payment is probably $300-$400 a month at best.
It's really low, and of course, then you factor in taxes and the HOA and things like that.
But he's still cash flowing. He's got to be cash flowing $500 at a minimum.
I just don't like it when investors overlook some of the more traditional ways of purchasing. Use mortgage money. It is the cheapest money available. Hard money, it's great if you need money quick and everything else like that. But there's points, there's high interest, there's extensions and everything else like that. Mortgage money is cheap, 4%.
Right.
Sometimes less, sometimes more. So, this is another thing that you need to factor in when you're making an investment is, the cost of your funding.
Right.
And another thing, I like investors to try and avoid is refinancing. Now, sometimes it's the right thing to do, sometimes it's the wrong thing to do. But, refinancing always costs money.
Right.
And every time if something costs you money, there goes a little bit of your equity.
Sure.
So, but
not to mention you're potentially tacking on another 5, 10, or 15 years onto a loan, depending what type of refinance these investors are looking to do. And I think, the best policy, just like you mentioned at the beginning of the podcast, is what's the goal with these rental properties if you're going to buy and hold. You could potentially be selling it at some point when the market is peaking, but I would think most people are in the game of a long-term hold. So how do you benefit from that, exponentially as you pay down that mortgage? And, doing a 30-year refi after you've paid down 10 years of a loan is just going to add another 10 years to, actually 30 years.
No, you keep
loan.
restarting the clock,
right.
and the asset
and the bank,
will never.
The bank is the only one that wins on that one.
Because you will never actually then own the asset, And, I mean, sometimes it's a good thing to do, is to, keep leveraging out your money and everything else like that. But I go back to the people that would just like to have some assets to diversify, all of their other investments. And the other thing, and I know I probably should have been prepared in my head to, give you all the, the return rate and everything else like that.
Okay.
But here's the bottom line that makes real estate magic is that once you, do your upfront investment, whatever that is, 20%, 25%, the rest of it, somebody else is going to actually buy that house for you.
Right.
So even long term, it makes it a very good investment, even if you don't get what, you hear, I need, $500 a month cash flow on this property and everything else like that. What if there's just even minimal positive cash flow, just enough, to, bank a little money to, for maintenance and stuff like that, and you've structured it, we'll just use a 15-year mortgage in this example. So you buy something for $150, and you put down the 20%, $30,000. In your $30,000, you take it out of your bank, and then you wait 15 years. And even if the property did nothing in terms of value, and it's still worth $150, I guarantee that you will not have saved up that $120,000 in your bank account that you would have 15 years from now if you let somebody buy that house for you. So that's part of the magic of real estate. Now, let me even take my example, and I think every investor always has to factor in worst case scenarios, best case scenarios. Let's say that place you bought for $150, put down $30, and paid it off in 15 years, and it's only worth $100,000. There was a real estate collapse, property values went down. Well, you know what? Your $25,000 turned into $75,000.
Right.
And you didn't do anything. Because you always have to calculate the opportunity cost or the loss of opportunity cost. But if you put your $25,000 in the bank, and for the foreseeable future, $25,000 is not going to turn into $100,000. Based on the rate that
absolutely,
banks are paying on CDs.
Absolutely. I want to just mention real quick. You referenced a 20 or 25% down loan. I know one of our sponsors for the meetup group that we host, Zach Karp from Success Mortgage Partners. He actually has some pretty interesting, unique products that he's offering right now. And I know at least one investor, because this is a new product, had contacted me a few weeks back, and they used Zach to close an acquisition, and they only had to put down 15% using conventional financing, which I guess the message I'm sending out to the investors is don't necessarily assume that you have to put down whatever the down payment amount is that is seen as the general standard. I mean, there are different ways, and there's reasons behind why you'd want to put down more or less. And those are all based on
you get
mentioned.
The private mortgage insurance if you put down less than the 20%.
Absolutely, but if the opportunity's there and it's the amount you have,
if it cash flows, I'm hoping that you let me on another one of your podcasts on low cost ways. I mean really low cost ways that people can start out in real estate investments. And I'll just bring up one. HUD has, if you buy a home from HUD, and people can search for HUD homes at HUDhomestore.com. Very easy to remember. It's a home store for HUD homes. HUDhomestore.com. You find one of those houses, and if you're willing to live in it for a year, which, it might take you a year to fix it up anyway if you're doing your own work, you can buy that house for $100 down.
Yep.
You can take it one step further. If it's really highly distressed property, it doesn't have to be, but if it is, and which makes it a low price and potentially a good deal, you can get from HUD renovation financing. You can get the money to renovate that house, and they combine the renovation money with your mortgage, and just so the house appraises for the cost of the purchase price and the cost of renovation, you end up with just one mortgage, and you can do that with $100 down.
Absolutely.
So if you're just starting out, that is a really good way to do it. Now, Fannie Mae, with their home style renovation financing, will do renovation funding for investors as well as owner-occupants. So there's ways of getting into real estate with little money and securely, where when you get to closing, you have a clear title, where you did have the opportunity to inspect that house so you really know what you're taking on. And this is what I like to do for investors. And once they have a little bit of success, then they, want to do it again and again and again. I have another guy that within the last year, he's purchased 7 rental properties, townhomes, through the MLS, and really, is thanking me every day for these investments. Again, he and his wife both have, very good careers. His objective is no way to spend every minute of his life, wheeling and dealing in real estate. He just wanted to have hard assets. He's actually, from another country.
Okay.
And a lot of investment in real estate is coming out of the country.
Sure.
American hard assets are still considered very desirable with all of the, manipulation that goes on with currencies, the overextension of debt by countries and everything, right, and bonds and all this other stuff that is going on, is that they're buying real estate here. We came up with a strategy, and he pounces on opportunities as they come up. They're not there every weekend. You can't, be one of these people where, Saturday I'd like to look at houses. Well, okay, maybe there's not going to be any good deals on Saturday. You have to be there when one pops up on my screen. You can leave work, get in your car and go to the property and then make a decision.
Oh.
It's fine with me if you don't buy it,
right,
but get there before everybody else does. Every person you talk to in your podcast and on your radio show talks about how heavy the competition is for buying good real estate investments.
Absolutely right. No, you brought up a great point. I mean, if you're gonna dedicate yourself to this type of a goal of building a real estate business and investing, you have to be ready to move, and that goes for any situation. So forget the MLS. I mean, it's and I don't mean that in a negative way. I mean, any situation, if the opportunity is there, you're not going to be the only one who's trying to get through that door. Very rarely, unless you've got a very exclusive relationship with the right type of contacts that might have access to these opportunities, which again are going to be most likely few and far between, if at all. Are you going to be the only person given that opportunity? So, great point. I mean, you got to be ready to move. One thing I wanted to bring up before we start wrapping things up, Doug, is the way that we work with some of the investors here at TANIS that you were an integral part of, which is the investor assessment profile. We discussed how there's opportunities for $100 down purchases through HUD Home Store. For example, we talked about rehab lending with a 203K. We touched on hard money and private money and funding these opportunities. One of the things I think that might help set us apart from some of the other brokerages out there, is the fact that when we have a client that comes to us and says, or a potential client that says, hey, I want to get involved in real estate investing, we start with determining, and I think every investor needs to listen to this part, determining what investment objectives that investor may want to be involved in or think they want to be involved in. What's the reason for them even getting started in real estate investing? We go through if they have any current real estate assets, and we discuss if there's an opportunity to potentially tap into those assets to acquire funding, for example. And then, what's realistic? Do they have funds? Do they have access to other sources of funds? And we help hone in on their actual investment strategy and what their personal philosophy is, so we can best, serve that potential client and help them do whatever it is in the real estate investment world that they're looking to do. And again, it's there's factors that go into it, which we determine in our assessment profile, including income levels and credit score issues, if any, and then what we just discussed, which is your time availability to commit to these real estate activities. I mean, these are real questions that I'm actually reading off of our investor assessment profile. So for those listening out there, I mean, we have to work with a broker that knows what they're doing in the investment world. Otherwise, you're going to be excluded from some of these opportunities just because, again, Uncle John and Cousin Nancy probably aren't as focused on building your portfolio or expanding your real estate investment compared to a company like ours. I don't want to cut you short, but we're about an hour into this podcast right now. Okay. And I'd love to have you on at another opportunity in the near future, because I think we have a lot more we can talk about, and I think it'd be very beneficial to the listeners to hear the words out of your mouth about how to help, succeed as a real estate investor in our market. But right now we got to wrap it up. Okay. So can we tell the listeners that are possibly interested in contacting not only TANIS but also you as a broker, what's the best way for them to get a hold of you, Doug?
Well, I mean, they can call the TANIS office, or certainly they can call my cell phone at 847-476-1942. And I would be happy to meet anybody for a cup of coffee to figure out, what their objectives are based on their resources.
Absolutely. So that's to get a hold of Doug through the TANIS office, which is our main phone line, is 847-594-4215. Doug's cell phone number, 847-476-1942. And he also has an email address that you can send him an email on, which is doug@tanisgroupllc.com. doug@tanisgroupllc.com. Well, Doug, I know this was a long time coming to get you on the show. I really appreciate you spending this time with me today, and I think we brought up a lot of great information for investors out there to benefit from. So thank you again for taking the time and recording this with me. Okay, I'll talk to you soon, Joe. Thanks much. All right, take care. Bye.
Thanks for listening to another episode of the Investor Empowerment Series radio show. Be sure to tune in next week for another empowering episode. We welcome your feedback, so please rate us on iTunes and Stitcher, and visit us at www.investorempowermentchicago.com or TANISGroupRealty.com.